All right, everyone, here we are again. So let me go get our notes. Now, last time we were looking at bonds, I believe we left off with our discussion about bonds and their features, but now we're going to look at something slightly different, which is risk associated with holding bonds. So bonds, like any other financial security, do expose investors to different types of risks. What we mainly talked about last time was credit risk. And of course, all bonds expose investors to, well, not all, I shouldn't say that, except for treasuries. All bonds expose investors to some form of risk, but the type of risk that we were thinking about last time was credit risk. And so with a bond of any kind, a bond is a loan. And so anytime there's a loan of money, that means there's always a chance that the lender will not get the money back. So when you're the buyer of a bond, you are the lender. You might not get your money back. Okay, so for sure, any way you look at it, except for treasuries, because they're guaranteed, more or less. I mean, let's just say that in order for you not to get your money from the Treasury Department, the government would have to be gone, or some catastrophe would have to hit the earth. You know, it would be at that level if you did not receive your payments from a Treasury security. Okay, so for all practical purposes, we can say that treasuries are risk-free. So except for Treasury securities, all bonds expose investors to some credit risk. Now, it may not be a lot. It depends. Now, of course, as we discussed last time, credit risk depends, of course, on many factors. Ratings agencies, such as Standard & Poor's and Moody's, do provide credit ratings for bonds so that investors have a clear idea about how risky bonds really are. Okay, so in other words, if you're thinking about buying bonds, you have to know how risky they really are. It wouldn't make any sense to buy bonds without having that information. Now, these agencies are not infallible. They do make mistakes, but they're taken very seriously on Wall Street. Pretty much whatever they say is what investors tend to listen to. And because there really is no better source of information than from Standard & Poor's and Moody's. And by the way, if you're ever curious about seeing what the credit ratings are for a bond, you don't have to subscribe to Standard & Poor's and Moody's, which I would imagine is very expensive. There's an organization called FINRA, finra.org. If you go to their website, what you can do is find out information about bonds that are currently trading in the marketplace. Now, I find this website to be a little bit poorly organized. So rather than searching FINRA, what I'm going to do is put FINRA bond prices and let Google do its thing, because I think it's a little bit quicker that way. So I don't know, I just find this website to be a little bit clumsy. So here we go, bond data. And let's say that I want to know, for example, how ExxonMobil's doing. I just randomly picked them. So search. Let's search for ExxonMobil. Now, what it's going to do is it's going to show me the most recent traded ExxonMobil bonds and their terms and conditions. Oh no, I don't know what happened here. I'm surprised. Well, all right. Well, you know what? It's not perfect. Let's try somebody else. It's not a holiday, so there's no excuse there. All right, let's try Walmart. There we go. Now here's Walmart. Now there's a bunch of bonds. There's always at any given time a large number of outstanding bonds. These are issued at various points in the last probably 10 to 20, maybe even 30 years. And you can see they're listed by the maturity date. Now, this one on top doesn't mature until 2030. Now, there's a pretty good chance that it was issued in 2000 as a 30-year bond, but we don't have to guess. We can look it up right now. But what I want you to notice is that right here, Standard & Poor's rating is AA. Now, the best is AAA. In fact, let me just quickly review with you the Standard & Poor's ratings. So we have AAA, AA plus, AA, AA minus, and let me just do something here. These paragraphs don't have to be quite so big. All right, here we go. And then we work our way down a ways. We have A plus, A minus, and then it goes to BBB plus, BBB minus. Now that's the cutoff point between the investment grade bonds and the rest. So these are investment grade bonds, as they're called. And that matters a great deal because some financial institutions are restricted by law from buying any bonds that are not investment grade. The ones directly below that are called either speculative grade or junk bonds, which is not a particularly nice name, but that's what they are referred to as. Then we start here with BB plus, BB minus, and you start to get the idea of B plus, B minus. Then it drops down to CCC plus. And when you get down to this neighborhood, these are bonds that are really on the brink. These are companies that may already be bankrupt or they're very close to it. So, it's just, this is the really very scary territory. And then I think they do have a D. I think that's as far down as it goes. Once you're down below this area, you're in deep trouble. Now, some corporations that have been around forever with big names do have ratings down in this area. Like I think Ford might be down at BB plus, but so they're getting close. But you saw that in our example, Walmart is at AA, which means they're pretty close to the top. Now that means if you buy one of their bonds, there's no guarantee you'll get all your money back, but it's going to be, there's a very strong case to be made that you'll get all those cash flow payments, because AA bonds just do not default very often. It's very, very unusual. And but having said that, the coupons are pretty generous here. They must have been issued. This is how you can tell. They're issued a long time ago when interest rates were much higher than they are now. So if you come here and look at this in more detail, you can see that the coupon is 7.55%, which is way above what you would get now. But in order to buy this bond, look at this price, $149.33. That means for every $100 of face value, you have to pay $149.33 or $149.33 to buy that bond. The reason why it's so expensive is because the coupon rate is so high. Any other bonds out there who are just being issued are going to pay 2 or 3%. So this is a very valuable bond. So if you bought this when it first came out, you're pretty happy right now because you've made a lot of money. In fact, if you sold it right now, you'd have a capital gain of nearly 50%. So then there's other key details here. Let's see, here it is, the offering date. I figured as much. It was issued in early 2000. It was a 30-year bond at the time, but now 20 plus years have elapsed, so there's roughly 9 years to go. But like so many other corporate bonds, it was issued initially as a 30-year bond. Okay, the moment it's rated AA by Standard & Poor's, AA2 is the equivalent in the Moody's scale. Almost without fail, by the way, Moody's and Standard & Poor's almost always agree with each other, but they do have different scales. I just find Standard & Poor's to be a little bit easier to follow. They've both been around for quite a while. And they really, like I said, they're the gold standard on Wall Street for bond ratings. And they don't just rate corporate bonds, they rate all kinds of bonds. They rate government agency bonds, they rate foreign bonds, they rate municipal bonds. Pretty much, if you need to know something about the bond markets, they're the place to go. What else do we know? Oh, the bond originally, the issue was worth $1 million. They sold $1 million worth of these bonds. And now at the time, only 588,473 of them are still out there. That's most likely because the bond was callable. I think it doesn't say that. Oh, maybe not. They may have simply retired them, which corporations can do. I mean, if they go out in the market and find that people are selling these bonds, the corporation can feel free to buy them back. And why would they do that? Well, it's kind of like an individual paying off his credit card debt. It's the same idea. So they've reduced their debt quite a bit here. And so if there were call and put provisions, they would be listed right here. It looks like this bond was not callable or puttable, which is a little unusual because a large percentage of corporate bonds are in fact callable. And so you can see the price as it's gone through time. There's a bit of a spike here for some reason in 2020, probably because the COVID broke out, like right about that time. So also this CUSIP number, this is a unique identifier. If you have this number, that uniquely identifies the bond in everybody's databases. Officially, each bond is associated with a CUSIP number. CUSIP is a company whose name I've forgotten. Let's find out. What does CUSIP stand for? Committee on Uniform Securities Identification Procedures. So it's a committee, but the idea is that it essentially just says, all right, oh, it's part of the SEC, I see. And what they do is they make sure every bond in the marketplace is identified with one specific number, and that's called a CUSIP number. That way there's no confusion about which bond you're looking at. All right, so this is all the details I guess we need to know. But anyway, the bottom line is it's a AA bond. So the reality is it's very unlikely that you'll not receive all your cash flows when they're promised. Obviously, Walmart is a very successful company. It's not impossible, but it's highly unlikely. In fact, if we could find some data, it might be, let's see. I wonder if somebody's put together a chart here where we can find out historically what kind of default rates have happened with these different classes. Oh, see, there's a lot of technical stuff here, but no, that's not what I wanted. Sorry, that was too technical, and they didn't even have what I wanted. Maybe we can find it here. I mean, sure, this tells us in general terms, but I wanted to see if there's a chart. Oh, wait a minute. No, that's something else. Okay. Oh, here we go. No, I guess not. All right, we don't want to waste our time, but let's just say that the percentage of bonds. All right, let's try it this way. I bet we can find it this way. Here it is. What was so hard about that? Why was that such a problem? This is it. This is the chart this is exactly what I was looking for. Okay, very good. Now I'm happy. So what they're saying here is this: if you have a AA bond, after 1 year, the probability of default is essentially zero. After 10 years, that only goes up to 0.03%. Oh, wait, sorry, that's municipals. These are corporate. Oh, okay. 0.50, so less than half of 1% likelihood that after 10 years you have not received all of your cash flows. That's a pretty small number. That's a tiny number. Although if you notice very carefully, now these, by the way, these are Moody's ratings. BAA is the same thing as BBB. That's the cutoff point between investment grade and speculative. And you can see why, because once you fall below that threshold, look at that probability. It jumps up from 4.85% to almost 20%. So that's why, even though it might seem it's only one level, like if you look at my chart here, you might say, wow, what's the difference between triple B minus and double B plus? Well, you can see the difference. That's pretty considerable. The probability of default quadruples when we fall below investment grade. And in fact, when you start getting down to these C's, like I was saying before, look at that, 71.38% chance. After just 1 year, the chance is 17.72%. That's pretty scary. So these bonds are the ones that, you're basically buying. It's like buying a car with 190,000 miles on it. I mean, come on. What do you expect? What do you expect to happen to it? It's pretty much the same thing. But it's interesting to look at these numbers. So you look at these AAAs, it stays zero all the way across. That's pretty amazing. But anyway, so yeah, this is all very interesting. If you really are interested in this stuff, you should send your application to Moody's or Standard & Poor's, because this is all they do all day long. Okay, now this paper was written 10 years ago, but nothing is likely to have changed since then, not really. So anyway, so that's credit risk. Now, why am I mentioning all this now? Because credit risk is not the only type of risk that you're exposed to with a corporate bond or any other bond. So I just want to mention, there actually is one other type of risk. All coupon-bearing bonds also expose investors to another type of risk, and that's known as reinvestment risk. What is that all about? When an investor receives coupon payments from a bond, which he or she will twice a year, they must be reinvested. Now, that doesn't mean you're required to reinvest them, but if you're investing for the long run, for your retirement, for example, this could be potentially a very important component of your rate of return, especially over a long period of time. So they must be reinvested to maximize the return to the bond. Now, here's the problem. When a bond is issued, there's no way of knowing the rate of return that investors will be able to earn from reinvestment income in the future, because no one knows what interest rates will look like in the future. Okay, so this is something common to all coupon-bearing bonds, and that includes treasuries, by the way. So even coupon-bearing treasury securities, and by that I mean treasury notes and bonds, expose investors to reinvestment risk. Okay, just because they're paying coupons, even if they're guaranteed, there's some chance that the reinvestment income will be much lower than you expected when you bought them. So, by the way, this is one reason why the strips market is so popular. We did go over this last time, I think. I hope so. Let me just double check. Just want to make sure I've already mentioned the strips. Sounds weird, but oh, maybe not. Okay, if not, I'll go over them right now because it's an interesting. No, there they are. We did it. So what we've got here is a situation where treasury bond dealers can take the cash flows from treasuries in their portfolios and sell the cash flows individually to investors on a discount basis. Okay, so what that means then is that they become a type of zero coupon bond. it's created synthetically from existing cash flows. So in other words, the Treasury Department itself does not issue strips. It lets the bond dealers create them artificially from existing cash flows from treasuries. The reason why investors like them so much is because they're not only free of credit risk, but they're also free of reinvestment risk. Okay, so it says right here, the advantage of a strip is that there are no coupon payments to reinvest. Therefore, the rate of return can be determined with certainty. So you know in advance what kind of return you're getting. So that's the nice thing about strips. Okay, now having said all that, though, the investment risk is likely to be relatively small compared to credit risk for many types of bonds. So it's maybe not the most important type, but it exists. Now, here's the big one. Now, another type of risk that all bond investors are exposed to is interest rate risk. This applies to all bonds in the economy, regardless of whether they are risk-free treasury securities or zero coupon bonds. In other words, everybody's exposed to this type of risk. And what is this all about? This risk means that if interest rates rise, bond prices fall, and vice versa. Therefore, interest rate risk primarily means that investors could lose money if interest rates rise. Okay, now with that being said, investors could gain money if interest rates fall. So just keep that in mind. It's like a double-edged sword. But remember, with that Walmart bond we were looking at, the owner of that bond paid $100 for it, and now it's worth over, it's like $149. That's a big increase. So they're pretty happy right now. Now, I don't see any here that are under $100, though. Wait here, well, that's just barely. 98.9, yeah, that's awfully close. So, all right, well, that just tells me that Walmart issued most of these bonds during periods when interest rates were higher than they are now. Otherwise, you'd have a combination of numbers that are above 100 and below 100. All right, so now here's the interesting part. Even though all bond prices fall when interest rates rise, they don't all fall by the same amount or even the same percentage. Some bonds are more sensitive to interest rate changes than others, which means that these bonds are riskier. Okay. Oh, by the way, I want to mention one more thing here. Notice how I said interest rate risk means primarily investors could lose money if interest rates fall. Okay, there do exist securities that actually benefit from rising rates of interest, but we're not going to go into that right now. I think the school offers a whole semester called fixed income markets or fixed income securities, where you would just spend the whole semester talking about all these different types of securities that are dependent on interest rates. And then at some point you would have to cover this topic. These are very interesting products. They are basically synthetically created, not from treasury securities, but from mortgage-backed securities. And so it's easy to create a lot of very different kinds of securities when you strip cash flows off an existing bond. So in fact, that's one of the motivations for stripping them. You could, in principle, rearrange the cash flows any way you like. In a lot of ways, it's no different than having a set of Legos where you can build them into anything you want. Oh, I like that analogy. Cash flows from treasuries, Legos. They're not that different, are they? And you know what Legos are like. You can create almost anything you can imagine from these basic building blocks. And so you can think of treasury security cash flows or other bonds cash flows as building blocks, which can be used to create any structure we like. So clever Wall Street people decided somewhere along the way that, there might be a market for these securities where you actually benefit from rising rates. And in fact, if you're interested to know, one of these is known as an interest-only strip, or IO strip, which is created from the cash flows of traditional mortgage-backed securities. I think we went over this last week as well. A mortgage-backed security, I'll just quickly remind you, MBS is a bond whose cash flows are generated by the payments from a pool of mortgages. That's really all that it is. And the simplest structure is very straightforward, but they can get very, very complicated very, very quickly. Anyway, so as I started to say here, even though all bond prices fall when the interest rates rise, they don't all fall by the same amount or the same percentage. Some are more sensitive to others, which means that they're riskier. Now, as it turns out, the two primary factors that determine a bond's sensitivity to interest rate changes are the maturity of the bond and the coupon rate. Okay, so depending on which one you have, do you have a long maturity bond or short maturity bond? The longer the maturity of the bond, the more sensitive it is to changes in interest rates. And now part of the reason for that is that this is because with a long maturity bond, there are more cash flows to be affected when interest rates change. And then, if you might recall, when we've looked at this website, which shows the yields of treasury securities, we've always noted something interesting, that if you look at them, the short-term treasury bills have very low interest rates, whereas the ones down here at the long end are quite a bit higher. And the reason for that is because the 30-year bonds are much more sensitive to changes in interest rates than the 1-month treasury bills. That's the main reason why they're paying so much more for the 30-year bonds than the 1-month bonds. And you see the pattern typically is it starts out low, the yields are very low, they tend to rise slowly, and then they start to rise very quickly. So this is one reason why long maturity treasury securities pay higher rates than short maturity treasury securities, despite the fact that treasuries are considered to be risk-free. Okay. So anyway, now with the coupons, And we'll get into this in the chapter. I just want to mention this. With coupon rates, the lower the coupon rate, the more sensitive the bond is to changes in interest rates, because this means that most of the income is being received in later years. So those are the two primary things that determine how sensitive the bonds are to changes in interest rates. Let me save this thing real fast before I forget. I want to make sure everyone has a copy of this. It's like the introduction to a novel, I guess. You're introducing the characters and saying, here's where we're going with this story, and now you have to know who all these people are and what they're doing. So now you know what we're talking about when we get into the chapter. So this is 8. I'll just call this document bond risk, and I'll post it up on the Blackboard later on. Okay, now, ideally, we would like to have a numerical measure that reflects the interest rate risk of all bonds so that we can compare them side by side and not compare apples with oranges. Okay, there are several measures that are designed to do that, exactly that. There's two ones we'll be looking at. Are known as, okay, so here they are. And this will mean nothing to you just yet. We're going to be looking at what's called Macaulay duration and something else called modified duration, both of which, by the way, are available to us in Excel. I'll just mention that as in passing here. We can calculate these algebraically, but they are also built in to Excel. Just a happy little side note there, because the calculations are a little bit messy. They're not that bad, but it's usually the case that Excel is the best way to calculate these types of concepts, partially because some of these bonds can have quite a few cash flows. So I'm going to open that one up. I have a document here where I'd like to put in some Excel examples, but also, some duration examples, but I'd also like to show everyone how, like, for example, here, we're going to set up this example and we'll put in the Excel formula, but not just yet. We'll get to this in a few minutes. Otherwise, it'll make no sense to us. So now we're ready to read the actual novel or see the actual movie, now that we have the right background. Okay, so this ties into what we were doing last week. So we're going to quantify the risk. Now, this other measure you're seeing here, convexity, I'll just add that to my document. In addition to these duration measures, we will define convexity, which shows how sensitive these duration measures are to changes in interest rates, because duration itself depends on the level of interest rates in the economy. So in other words, if you have like a low interest rate environment like we have now, and you calculate duration, you'll get different results than you would in a very high interest rate environment. So the convexity is a way of telling how much the duration is going to change over time as well. So having the two of them together can be very helpful for predicting what could happen to our bond prices if something changes. So for example, the duration, these measures, duration and convexity, are heavily used on Wall Street by portfolio managers, especially fixed, not, well, any portfolio manager that does manage bonds, and investors to understand how much a bond's price can change if our assumed changes in interest rates take place. All right, so there's an investment manager or portfolio manager decides that rates will be up a higher 1% next year at this time. We can figure out how much the bond prices should be at that time. And that will give us an idea as to whether or not we should keep these bonds or sell them. So this way we know what to expect. And those, if we believe we understand where interest rates are heading, and that's a challenging thing to do, of course, then we can at least say, well, you know, if we're right and rates go up by 1% next year, at least we know what might happen to our bonds. And then we can use that information to make decisions. Should we buy more of them? Should we sell them? Should we hang on? Should we buy derivatives to hedge them? There's all kinds of decisions we could make, but this way we at least have a clear idea of what could happen based on different interest rate assumptions. And in fact, what they'll probably do, these market participants will attempt to forecast future interest rates based on economic conditions, and they may use scenario analysis to determine what could happen to their bonds based on different potential outcomes in the economy in the future. So you might decide, well, I don't know what's happening next year, but I have a few ideas. And so let's see what would happen if, let's say, interest rates go up 2%. And if they go up 1%, and if they stay where they are, and if they fall 1%, or if they fall 2%. And so let's find out, what does that do to our bonds, and then maybe average them out somehow. So, you know, all this ultimately depends on our ability to understand where interest rates are going in the future. So modeling interest rates itself is actually a very challenging activity. And as you can probably imagine, because, you know, let's face it, nobody really knows what the future is, but at least we can get a sense of where we might be going if we pay very close attention to economic data, like the money supply, for example, or anything the Fed might happen to say, or inflation rates, you know, or things like that. We can use them to potentially forecast interest rates in the future and then determine the impact on our investments in bonds. All right, so with all that being said, we're ready to start looking at this chapter. So duration and convexity, we'll be analyzing these in Excel. So interest rate risk is the chance that the value of an investment will fall, but specifically bonds, but any investment that's tied to interest rates, the value might potentially fall due to a change in interest rates. This is what we're worried about. Now, stocks, interestingly enough, the relationship between stocks and interest rates is not nearly as clear-cut as it is with bonds. For some types of corporations, higher interest rates could actually be helpful. For example, a corporation, or particularly a financial institution, that makes all their money lending to customers, they might actually benefit from that. But many companies would probably suffer because the cost of borrowing would go up. So, but it's still not as open and shut as with bonds. Pretty much all bonds will lose if interest rates go up. Stocks, it depends. Anyway, so duration and convexity are used to determine how sensitive an investment's price is to changes in interest rates. Okay, even if we know the direction, we don't necessarily know what percentage it's going up and down. All right. So we're going to use duration. Now, there are other measures we could use. This is one of the more popular ones. And it has a long and interesting history. But unfortunately, it is based on several very strong assumptions. And as is so often the case in economics and finance, um, in order to relax those assumptions, the modeling that we do, or in this case, the measure that we're looking at, would have to be vastly more complicated to get around those assumptions. So in other words, we're trading off a little bit of unrealism in exchange for a simpler model. You'll see what I mean as we're going along. But that's always going to be a problem in economics and finance. More complex models may improve the realism of our assumptions, but the question is whether they're worth all the extra complications, because they can be much more difficult to implement. All right, so the basic duration measure we're looking at here is very simple. We'll be doing it in Excel. The more advanced versions require us to actually write computer programs, very sophisticated computer programs, by the way. So here, though, we can at least gain insights into how this process works. Okay, so duration was first written about by Frederick Macaulay in 1938. In fact, I mentioned earlier that one of the versions of duration we'll be looking at is Macaulay duration. Well, now you know why. The inventor was Frederick Macaulay. He wrote a history of the movement of interest rates, bond yields, and stock prices in the US since 1856. Now, you would think that something like that would have already been done, but apparently not. You know, a lot of the data that we have access to today, we kind of take it for granted. But, you know, in those days, somebody had to sit down and do all this research, and who knows where he found it. Not in computer files, that's for sure. So this was quite a massive undertaking. And when he was done, he noticed patterns in the relationships between prices of bonds and interest rates. So he developed this measure to help us understand how much bonds price is affected by interest rates. And now he didn't call it Macaulay duration. That's only after the fact that authors chose to call it or name it after Macaulay. He called it duration. He wasn't an egomaniac, you know, if it sounds like that. He called it duration in his book, but later authors chose to call it Macaulay duration in his honor. Okay, so now Macaulay was doing research because, if I remember correctly, he worked at maybe a bank or a brokerage house. He was working at some financial institution. And what they were worried about is this. For any financial institution, one of the biggest things they have to worry about, let's do a little detour here. One of the biggest problems is the mismatch between the maturities of assets and liabilities. What do I mean by that? Okay, so for a commercial bank, let's say, the assets are the loans made to customers. The liabilities, are the deposits of the customers. So they bring in the customer's money, the customers bring in their money and they say, I want to put this in my account. Fine. So then what does the bank do? They take that money and they lend it out to customers. Now, here's the thing though. How do they make their money? Well, two things are happening. The deposits, well, of course, the deposits have relatively low rates of interest. But they also have a very short maturity, since the customers or depositors can withdraw their funds anytime. Okay, so I can just go to the bank and say, I need my money back, please. The loans to customers pay higher rates of interest, which is good for the bank, but they have a longer maturity. So for example, a typical car loan might last from 3 to 6 years. So what this means then is that while the depositors can take their money back anytime, the bank cannot get their money back from a car loan until the maturity date has been reached. They can't just say to you, we're out of money. You got to give us the money back now rather than wait till what we agreed to. So that by itself can be a problem. But what's important, even more important, is this. Now, I'll give you, we said this already. The longer the maturity of any financial security that depends on interest rates, the more sensitive it will be to changes in interest rates. So let's see how that affects the bank. Okay, so for a bank, the assets have a long maturity, meaning high sensitivity to interest rates. And the liabilities have a short maturity, low sensitivity to interest rates. Now, what does that have to do with anything? So suppose that interest rates rise. The value of the bank's assets will decline significantly more than the value of the liabilities. Now, even though the deposits and the loans are not bonds, their value still depends on interest rates, because their value is actually equal to their present value. So in other words, the liabilities of the bank will lose very little, while the assets of the bank will lose significantly. So on balance, the bank's position is worse off or has deteriorated. Okay, so it's like, imagine, it would be almost like this. Imagine that your liabilities are going down a little bit, but your assets are going down a lot. So on balance, you're losing out. So the bank's position is deteriorated. Now, of course, if interest rates fall, the opposite will happen, and the bank will benefit. But this does mean that the bank is heavily exposed to the risk that interest rates will rise. Okay. So the banks are scared. They're like, what happens if rates go up? We're in trouble. Oh, okay. So what Macaulay wanted to do, developed his measure to help financial institutions determine if the gap between the maturity of their deposits and liabilities was too great, meaning that the banks were exposed to too much interest rate risk. In other words, the banks themselves might not have realized that this was happening because there was no research done about how much could we lose if their interest rates go up or down. So the Macaulay duration was designed to help the banks at least measure how much exposure they had to interest rate risk. And so that way, if they felt like the gap was too great, what they could do, for example, is stop making such long-term loans and maybe make shorter-term loans to customers, or else encourage the customers to leave the money in the bank longer with products like certificates of deposit. But having this measure would have made it simpler for them to manage their risk than not having the measure at all. So now keep in mind too, these are in the days when there's no computers, there's not a lot of financial data available. So they had to have some way to help them figure out what should they do to keep their risk to an absolute minimum. So that's why Macaulay's measure was so helpful at the time, although later on it was updated for different types of purposes. In particular, Macaulay duration was useful, but for specialized applications. A newer version known as modified duration was developed because it had broader applications to basically all interest-bearing securities. I don't know if anybody is aware of, obviously whoever invented it, their name must be lost somewhere. Oh. So it says here, I didn't even realize that he was Canadian. Macaulay duration is a weighted average of the times until the cash flows are received. So that will prove to be not the most useful measure when it comes time to other applications like determining the risk of a bond or the risk of the sensitivity of a derivative security and that type of thing. And the whole point of it is that you're really just trying to figure out how long does it take to get your money back when you invest or lend money. But modified, it's a more precise measure of price sensitivity. It can be applied to bonds, but other types of securities that are defined as a function of yield. And so now there's also this other one. We're not going to look at this one, effective duration. We'll get to that maybe some other time, but it's a little too complicated for this one chapter, I think. So anyway, let's get back to the slides. Now the formula looks terribly frightening. I'll grant you that. So before I frighten you any further, let's look at an example. I put together in this spreadsheet, here's a bond that has, now by the way, here I'm keeping things simple. It's an annual pay bond. Coupons are paid once a year. Okay, we can do this just as easily with semi-annual, but I think it just complicates it unnecessarily. So suppose that a bond, a 10-year bond, was issued 5 years ago. Okay, now this bond was originally a 10-year bond, but it was issued 5 years ago. It is now a 5-year bond. And what do we know about this bond? The face value is $1,000. The coupon rate is 6%, which means that the coupon is $60 per year. And currently, the yield is 3%. Okay, in other words, interest rates have dropped. In other words, interest rates have fallen since the bond was issued. That's why the price is, as you can see, it doesn't, here it is. The price is $1,137.39, which is more than the original face value of $1,000. This is because rates have fallen since the bond was issued. And in fact, this also tells me, since the coupon rate is 6%, the yield at the time of issue would have been 6%, because bonds are typically issued with a coupon rate that exactly matches the coupon rate, or the yield. Sorry, the coupon rate is chosen to match the yield. It's not necessary, it's just a convention, but this is what we see most of the time. Okay, so what you see here are the cash flows to this bond. We have the yield. Now, for the next 5 years, we're entitled to receive a $60 coupon. And in the last year, we also get our face value back, $1,060. So the question is, how do we figure out, first of all, what is the price of this bond? And secondly, what are the two durations, Macaulay and modified? Now, the easiest way to do this, without using Excel's formula, of course, is to just basically show the cash flows and the present values. So this formula that you're seeing here is basically what I'm doing here. In fact, why don't I copy this into Excel? And you might say, I don't know if that's true or not, but there it is. So what exactly are we doing? Well, first things first, in this column, we have what's called PVCF, present value of the cash flows. All right, let me make that a lot bigger. And then the T means time weighted present value of cash flows. So according to Macaulay duration, we should take these present values and we need to weight them by the time in which they are received. In other words, we're going to take the present values and multiply them by time. Okay, so here, now how did I get this number, 5825? What I did was I took, actually I'll do this by hand. Each present value is a result of taking the cash flow in that time period and dividing it by 1 plus the yield and raising that to the T power, where T is the time at which this cash flow takes place, as you can see in column A. All right, and T, PC, well, I'll write that in here too, although it's pretty self-explanatory. T PVCF equals PVCF multiplied by the time at which the cash flow is received. And I will make that bigger. And the cash flow is received. That's what it says. Okay, so in other words, in this column, I've applied this formula. Now you could do this with Excel, or I've used the algebraic expression right here. And so I know what the present values of each of these coupon payments, and they're steadily declining. But then down here, I've got the coupon and the face value, 914.37. So I add these up, and this number that I'm seeing here is the price of the bond. Because remember, the bond's price is nothing but the present value of its future cash flows. So that's the price. Yes, it's not a coincidence. Now over here, I multiplied these present values by time. And so you can see these are the same because the time is 1. But then this is double this is triple this, et cetera, et cetera. This number is the sum in this numerator. In other words, this numerator in my example, let me just fix this. Okay. You see this 51, 21, 15. In the denominator, I have this expression, which is 1137, 39. And you can see now the ratio of these two is what we're looking for. And you can see right here, it's 4.50. And, Macaulay defined this in terms of years, which means that it should take roughly 4.5 years to recover your initial investment in the bond. That's how we defined it. Okay. Now, Excel has its own formula. Let me show it to you. You have to be careful with it because the way they explained it in the formula guide, I believe it's called, let's try duration. Actually, I'll tell you what, let me use the this thing. No, not. Let's see if we can find duration. Okay, according to this, Macaulay duration is M duration. Now, the problem with this thing is it's a little bit awkward. So here's what I have to do. Settlement and maturity date, what I'm going to do is need to pick two dates that are exactly 5 years apart. So let's go with, well, let's see. How about July? See, I'm not sure how it wants us to type this in. I don't think it'll accept this. 5 years ago would have been 2016, 2021. The coupon is 6%. The current yield is 3%, and the frequency is once a year. Now, I was afraid of that. So how do we work around that? Here's what we have to do. Excel stores dates as numbers. In other words, if I put right here, 7/6/16, okay, no. And 7/6/2021. If I've done this correctly, there we go. Those are the two dates, okay? This is the date that goes with 7/6/16. And this is 7/6/21. Okay, so that's why these are here. So if we want to use the Excel formula, it requires that. So let's try that again. Oh, wait a minute. So use this as your settlement. Oh, look what it did to me. I thought it. All right, watch this. All right, now we're all set. These are the same things. Okay, so let's try it again. Macaulay duration, settlement, maturity, coupon, 0.06, yield 0.03, frequency 1. Actually, you know what I'm going to do with this? I'm going to use this. Okay. You see now they goofed because that's actually the modified duration. Ooh, see, it looks like Excel has done something very wrong here. So what I'm going to do is try, I think they are very confused here. Let's try their duration function. So there's two of them. There's duration and there's modified duration. Yeah, I think they screwed it up. So the settlement is here, 0.06. The yield I'll put it here. Frequency is 1. Yeah, you see. I should write to them because you know what that means. That means these descriptions are not correct. So if you noticed, when I typed this in, this M duration, it was described in here as Macaulay. That is not correct. This is modified duration. So, I see what they did. They call it Macaulay modified duration. Nobody else on the planet calls it Macaulay modified duration. It's just modified duration. That's why I was confused. So don't you be confused. This one is Macaulay. This is modified. So we know how this was obtained. It is the ratio of these two numbers, as you can see up here. Now, the modified duration, which is the one we really want, is obtained by making a very slight change to the modified duration. Now, this is the formal definition of modified duration. It looks frightening. Where's it coming from? Let me just show you really quickly. What does it even mean? Well, I think I showed this to you once before. If you took a bond, and let's say this bond, and I continuously changed the yield and calculated the equivalent price, you know from experience that the price is here and the yield is here. And there's an inverse relationship between the two. This is the price yield curve. So what this modified duration measure is actually saying is that if I took the derivative of this curve and then I divided by the bond's price and say this is my slope here, the derivative here is actually the slope of the curve. Oh, and there's also a negative in there. We'll explain that in a second. The dPdi is the slope of this curve. We divide out the P. The only reason we do that is so that we can compare all the bonds in the economy on an equal footing. Okay, dPdi by itself would be affected by the price of the bond. So we're only interested in the sensitivity. So we have to do two things. We need the slope, We need 1 over P. We need the negative sign. That's more a convenience than anything else. That's not absolutely necessary. But what happens is, the reality is people don't like negative numbers. And since this, you can see the slope of this curve is guaranteed to be negative, and we don't want a negative duration value, all we have to do is multiply it by -1, and that's guaranteeing it to become a positive number. Now, this measure here is an approximation because we're using the deltas instead of D's, but it is the same concept. Okay, so the bond, or I should say the duration measure, the modified duration measure, equals the slope, or the negative, the slope of the price yield curve with the impact of the price divided out, so that all bonds in the economy can be compared on an equal footing. Now, you might think that this is a terribly complicated thing to do, and it can be. If you actually do it directly, like you see here, this requires a lot of calculus. Well, we don't want to do that if we can help it, do we? No. So luckily, it turns out that the two are actually related with a very simple conversion formula. Look at this thing. This is telling me that all I have to do, now, by the way, this Dürer, this is one of the really unfortunate things, is that modified and Macaulay both start with an M. So Dürer, we're going to use that to represent Macaulay duration. And D, just plain old D, will be our modified duration. Okay, so in order to take, what we're basically saying here is that if we know the Macaulay duration, we can easily convert it into modified duration with this very simple formula. I is the yield to maturity. And M is the coupon frequency. And so M equals 1 for annual pay bonds. And M equals 2 for semi-annual pay bonds. And that's all we have to choose from. Bonds in the United States are never going to pay coupons for a different frequency than once or twice a year. So look how easy that is. Now let's go back to our spreadsheet. Now I've already done this with Excel's formula, but look what I did here. Because it's annual pay bonds, I literally just have to take the Macaulay duration and divide by 1 plus the yield. Right here, C3. And that's it. So the modified duration, as you can see, is slightly smaller than Macaulay duration. So this is the one. And so the way we can think of this is, since the modified duration, all right, let me increase the font size here. Since the modified duration is 4.37, this means that a 1% increase in the yield to maturity reduces the bond's price by approximately 4.37%. Now that's easy to interpret. And then, and equivalently, a 1% decrease in the yield to maturity increases the bond's price by approximately 4.37%. Hold on. So that's how we can interpret it. Now, it turns out that if the change in the bond's yield is very small, then the duration, modified duration measure will provide a good approximation to the actual change in the bond's price. So it'll work pretty well as long as we don't change the yield too much. And in fact, we're going to prove it in a few minutes. But before we do, we need to have a little detour again. Okay. By the way, this is the example we're working on. It is in the slides, all the details. But I want to do a little detour here. We recall that interest rates are expressed as a percentage but for using when using formulas, is easier to express interest rates as a decimal. Okay, so what do I mean by that? 1% is the same thing as 0.01. 0.1% is 0.001. 0.01% is the same thing as 0.0001. Now, on Wall Street, we have this convention, which is very useful. Changes in interest rates are often expressed in what are called basis points. For example, 1%, which we know equals 0.01, is known as 100 basis points. 0.1% is 0.001, 10 basis points, which are, oh, by the way, these are often abbreviated basis points, as you can probably guess. And then 0.01% is 1 basis point. Okay, this is to avoid potential confusion. This system, this convention, is designed to avoid ambiguity. For example, suppose that the current rate of interest is 5%. If I say that rates increased by 1%, this could mean that the rate increased from 5 to 6, or it could mean that the rate increased by 0.05% from 5% to 5.05%. So you can see the potential exists for this to be ambiguous. So if instead we say that rates have risen by 100 basis points, we know for sure that this means from 5% to 6%. Okay, so that's why this is a common Wall Street convention, these basis points. So anyway, what does this have to do with anything? Well, let's find out. What I'm going to do is copy this into the next tab, and I want to do an experiment here. So what I'm going to do is say, oh, listen, and this has already been set up. Let's say the yield change is 1%. Currently, the bond is yielding 3%. What if the interest rates in the economy go up 1%? And so our yield goes from 3 to 4. So the yield change would be listed as 0.01, 1% or 100 basis points. Now, remember, actually, no, you know what I just realized? No, I have to manually change this from 3 to 4. So the price, when the yield was 3%, let's just make these a little bigger. When the yield was 3%, the price was $11.37.39. So what I'm going to do here is type next to it what the predicted price will be based on duration. So if the yield goes up to 4%, according to duration, it should increase by 4.37%. Right. In other words, it should go up to about 1187.093. That's an increase of 4.37%. Let's see. 4.37%. Okay. All right. But let's see what it turned into. Now, if I change this up here, it'll automatically update the price 10. Oh, I just realized something. I did this wrong. It should go down. Sorry, hold on 1 second. Okay, there we go. A decrease of 4.37% is what we predict. But what we actually got is 1089.04. Well, so you can see they're off a bit. There's a difference here of $1.40 something. So that's not a very good prediction, is it? No, but the reason why that happened is because the change is quite a bit, a full percent. Whereas now, if you come back here, you'll see that I've already done this for 1 basis point. And what happens when I change it? According to duration, the price should go down by about 50 cents. Well, let's see what happens. If I go from 0.03 to 0301, all right, well, that's exactly what happened, pretty much. From 1137.39, that's 50 cents right there on the dot. So in other words, because the change was so small, 1 basis point, the prediction is almost perfect. So that's one of the things we have to watch out for with duration. It's it works, but only for small changes in interest rates. If the changes are large enough, then it starts to lose its accuracy. Okay, so that's an important detail. Now, another thing I just want to point out here is that this goes back to our discussion about assumptions. One of the drawbacks to both types of duration is that they're based on the assumption that when yields change, the entire yield curve changes by the same amount. Okay, so let's say, for example, we're looking at a 5-year bond like we are now. And I assume that yields go up by 1%. So this is the Treasury yield curve, the current Treasury yield curve. If I say that rates go up by 1%, I mean that the curve did this. So in other words, the entire yield curve, not just the 5-year yield, is assumed to shift up by the same amount. In other words, all shifts of the yield curve are parallel to the original yield curve. So that's something we have to take into account when we try to figure out what actually happens. Now, some of the more advanced versions of Excel duration do not use this assumption. But you might say, why don't we use them? They are dramatically more complicated to implement. So in other words, well, you might say to yourself, well, we only need a rough approximation. What the heck? Let's use the assumption of parallel yield curve shifts. But for certain types of securities, this is not going to work very well. In particular, the assumption of parallel shifts will be a major drawback when analyzing bonds that contain embedded options, such as a call feature or a put feature. So we just have to bear all this in mind. What we're doing here is only giving us an approximation, but in practice, if we have options involved, that means that this assumption is not very helpful. But you can see it's giving us a pretty decent first approximation to what might happen to our bond price if there is in fact a change in interest rates. So here, you can see that the actual change in price was not the full 4.37%, but it was a significant jump, or decline rather, because rates went up by 1%. Okay, so anyway, so there's our example. Now, what we can do here, there's a couple of other things we can do with our duration measure, but I see that it's 8:30. So why don't we knock it off for a few minutes, and let me show you a few more useful things we can do. And then we're going to introduce briefly convexity. Okay, convexity, we don't want to spend as much time with it because it's not quite as important, but we do want to understand what it means. Okay. All right, so let's knock it off for a few minutes. And when we get back, we'll dive more deeply into applications of duration. Okay. All right, great. All right. So what do we have to do here? Hold on. All right. So what's next? So there's some interesting things we can do with the duration. Now, if you recall the way we defined it, the correct, formal definition involves derivatives. Okay, but we can simplify that a little as we did in here, and we can rewrite this as, here it is. Now the D, this is of course the Greek letter delta. Now this represents a small change in something. Whereas with the derivatives, these D's are actually differentials, as they're called. These represent an instantaneous change. So we're actually going to use these to get some interesting results based on this definition. So, for example, if we rewrite this slightly, so let me just quickly, hold on. I wanted to copy this definition. There we go. Now remember, by the way, in my slides, capital D means modified duration. I've been using DUR or something for modified. For Macaulay. We don't really need Macaulay any longer. It was meant for a different type of application, but once we've converted it into a modified duration, that's what we'll stick with from now on. All right, so let me bring this back here to this slide. And you'll see what I mean. All right, I should be able to hide here. I'll hide it over here. So algebraically, if I rearrange this equation, you can see, what do I have here? This expression here basically tells me the dollar change in the price of a bond due to a given change in yield. So in other words, if I choose to change the yield curve by delta I, whatever that is, 1%, 1.1%, this tells me the dollar price change that I can expect. And down here, so this is the dollar change. If I'm only interested in the percentage change, I can divide both sides of that equation by P and end up with this expression. So in other words, the percentage change is equal to negative D times delta I. The negative is needed because remember, the bond price and the duration go in opposite the bond price and the yield go in opposite directions. So if I go back to my spreadsheet, you can see that's exactly what I've done. In fact, that's where this is coming from. This change in price has been calculated as, let's see, I should be able to put these symbols in here. Delta, actually, no, it's negative dp delta I. Oh, okay, it doesn't like that. Hold on. There it is. Now for this one, I'm doing the same thing, only I'm dividing both sides by p. So therefore, I'm left behind with just simply negative d delta I. So these are approximations, but remember they work well when the change in I, delta I, is very small, okay? Typically 5, 10, 20 basis points. Once you start talking about one full percentage change, meaning 100 basis points, then the approximation does start to break down a little bit, as we saw here, okay? But for the most part, if the yield curve change is not that dramatic, then this duration measure can help us forecast fairly accurately what impact this is going to have on our bonds. And this is coming, like I said, directly from the definition of duration. So that's kind of an interesting application. Now we're ready for this convexity measure. Now this one is a little bit messier. What I really just want to show you, I don't think we have to spend too much time with this, but we're going to look at a numerical example of it. And let me just try to show you exactly what it's all about. So let's just say, let's go back to our document here and look at a diagram of the price yield curve. So just a quick reminder, if you look at this price yield curve, the duration, modified duration, is approximately equal to negative dp di 1 over p. Now, again, that is the slope times 1 over the price. So imagine the following scenario. If the interest rate or yield is here, this tangent curve, now remember the tangent, the slope of this tangent line is the derivative of the function at that point. So this here, the duration is a very high duration. And you can tell because the tangent line is so steep. But if I start getting up here in this territory, let's say this is 5% and this is 10%. And let's just say that the price is 1,200 here. I'm just making these up, but you can see that here are the prices, let's say 900. If you look at, though, at the tangent curve, the tangent to the curve rather, the tangent line to this curve is quite flat, certainly flatter than you had here. So steep tangent line. Down here, we have a very flat, although I'm trying very hard to draw it properly here. You know what I'll do? Let me change these to a different color. Now, these are a little bit exaggerated, but this one is a very flat tangent line. Which means the slope is very low. So therefore, we have a very low duration. Because the curve is flat, the slope is flat, is very low, and we have a very low duration. So basically what we're seeing here is that the duration itself depends on what the yield is. So the duration depends on the yield. With low yields, the duration is very high. And with high yields, obviously it's the opposite. So with low yields, the duration is very high. And with high yields, the duration is very low. So the convexity measures how much the duration changes when the yield changes. So it basically what it's measuring is how sensitive is duration to the yield itself. Okay, in other words, it is measuring how much duration or how sensitive duration is to changes in the yield. Now, it can be used combining duration and convexity to approximate the price change of a bond is more accurate than using just duration. There's just one problem though. In many cases, using both or adding convexity only makes a very small difference in the accuracy of the price change. So sometimes it's not worth the trouble is what I'm saying. You know, and a lot of times we don't even really use it. The convexity is helpful. It's likely to make a big difference when a bond contains embedded options, as we discussed earlier, such as embedded calls and puts. For bonds with no options, the difference will be much smaller, or the improvement from using convexity is likely to be very small, but it's available if we need it. All right, so because it's kind of a complicated thing to calculate, what I think we'll just do is let me just show you how the formulas will change. In other words, if I decide that I need both of them to approximate the change in the price of my bond, this is what I'll use instead of what I had before. In other words, it's the same as what we had earlier with just duration. And this piece at the end, this is the increased accuracy due to using convexity. Now you can see though why this is likely to be a small number. We have delta y squared. Delta y itself is already likely to be a very small number. Even if it's 1 full percent that we're changing, that's 0.01 squared, which is likely to be a very small number. So we typically only use both duration and convexity for certain types of bonds. Like I said, the ones that have options in them or other special features. Most of the time, it's good enough to use just this piece, just the duration. So yeah, and it's a very complicated setup. So rather than spending time with this, what I think we should do is jump ahead and take a look at the next chapter, at least introduce it. So this was our discussion about bond risk, which, you know, it's kind of mathematical, but it's extremely interesting and important. So why don't we jump ahead, and we're going to introduce ourselves to chapter 10. 10 is basically a brief overview of stock trading. We're not going to look at stock pricing just yet. That's going to happen in chapter 11. So we just want to take a peek at it tonight. Okay. It's not very quantitative. We just want to introduce ourselves to the stock markets so that we can then develop stock pricing models. Now, before I forget though, we're more than halfway through the class now, I believe. And at some point we have to start figuring out what to do about tests. So I'll post some information and an announcement. I think we may want to get started reviewing as soon as next week. So what I'll do is I'll post some review materials on the Blackboard, and I'll send you an announcement which announces what chapters we should be covering. And then next week, in addition to new material, I think what we should do is probably look at some practice problems so that we can get ready for the midterm. Now, let me just take a quick peek at the syllabus. I have to remind myself, I wrote it such a long time ago, what it says. Syllabus, here we go. So according to this syllabus, we should be doing chapter 10 tonight. This is week 6. And we're about to start it, so we maybe are a pinch behind. Not much. Because like I said, 6 is 10 rather. Chapter 10 is a fairly straightforward chapter. And 7 is a little bit more complicated because we're dealing with stocks and the capital asset pricing model, so that'll be a little bit messier. So according to what I'm seeing here, ooh, boy, we saved some heavyweight stuff for the end, I saw there. Let's take a quick look one more time. You know, now that I think about it, oh, yeah, there it is, 40%. So what remains to be determined is which chapters will be in the midterm and which chapters will be in the final. So I'd like to obviously cut the material in half, roughly, to the extent that's possible. So I'm still thinking about it. But whatever we do, we definitely need to review. Okay, I can't just say, well, you know, we'll just do what we've been doing. So let me go back to the notes for a second. Now, I think I did assign the practice problem from chapter 3, but that was the only one. Maybe we'll have some more, don't worry. But right now, I think it's more important to focus on the test. So I don't know, maybe we could run 1 through 6. Maybe we could save bond markets for the final. Yeah, I think we could do that. So I think maybe I'll start to write a bunch of problem sets that we can work on next week. And let's just say that we'll decide tentatively to have the midterm on 1 through 6. Well, all right, well, maybe we'll sneak in a little 7. No, maybe 1 through 6. We'll see how it goes, but that's roughly what we're aiming for. And then the final exam is whatever comes after that. Okay, so there'll be a midterm and a final. The assignments, we'll get them done, don't worry. Well, they'll add up to about 20%. But this is really obviously the most important thing. And of course, there's no papers. You know, during the summer, who wants to write a paper? I mean, really. So, all right, so here's what we'll do. I will get some review notes up there along with some problems. And next week at this time, we'll go over them. Now, you'll be able to take this home with you. I mean, this is a take-home exam because, of course, this is an online class. And, you know, I can give you plenty of time to finish it. And you'll have all your notes and all the rest, the videos, the slides and everything. But I still feel like we really should review for it. Okay, I don't want to not review. And the same thing is true of the final. At some point, we'll find ourselves reviewing for the final. And let's see, how far are we going? Oh, here it is. I just want to remind myself how many chapters we're doing here. Just to get a sense of, because I think after tonight, we're only going to meet 4 more times. So we still have to do stocks in the CAPM. Let's see, forwards. Oh, then some derivatives. We'll do some derivatives. And that's forwards, futures, options, and swaps. I think that'll take care of everything. So clearly the second half of the class will be a little bit more involved. So, all right, so we'll figure it out, but just be prepared to start reviewing next week, in addition to doing whatever new content we want to do. So then you'll have a while to get your exam done, and then the final will occur the last week of the course. I think our last meeting is very early in August, like whatever is the first Tuesday in August. I think that's our last night. So we're slightly more than halfway done. We still have quite a ways to go. So, all right, let's just dive into chapter 10 right now. Now, nothing in this chapter is very complicated, and you may already be familiar with a lot of it, but that's going to change very quickly in chapter 11. So, it's nice to occasionally have a very qualitative topic, but that won't last too much longer. All right, so let's take a look at this. Now, we're going to introduce very briefly stock and stock trading. Now, of course, if you have a 401k plan where you work, most likely you've invested the money into stocks or possibly a few other things, maybe. You might have some bonds, you might have some money market securities, you might have real estate, but you probably don't have individual stocks. You probably have funds of stocks. Okay, this is typically what they offer you. They don't normally let you buy individual stocks because it's not, it's a little too risky. They do not want you to lose all your retirement money. Let's put it that way. So most of these financial institutions that manage this money are going to offer you through your 401k plan the opportunity to buy funds of stocks or funds of bonds or whatever the case may be. So, but the thing about stocks is, compared to all the other securities that are available to us, over time, stocks consistently provide us with the highest rate of return of all financial assets in the United States. So, in other words, if you're looking at the big picture, like retirement, for example, most likely the majority of your funds are probably best off invested in stocks. But even then, you have to be careful. You have to have, hopefully, you'll have a diversified collection of stocks where they're not all affected in the same way. For example, you don't put all your money in oil stocks and nothing else, because then you're big time vulnerable to sudden, dramatic, sharp drops in oil prices. So even though you might have some good years in there, you might have some really awful years as well. What you want instead is a portfolio that just does very well most years. And the best way to do that, as we'll see, is through what's called diversification. We'll discuss that more in the next chapter. But here, the word diversification simply means don't put all your eggs in one basket. That old saw about don't put all your eggs in one basket, what they mean by that is don't put all your risk in one area, spread it around over other areas. Okay, now stock exchanges, we all know what they are. We know where they are. The most important and famous one in the world, of course, is in New York City in the Wall Street District, the New York Stock Exchange. This is where stocks traditionally were bought and sold. Of course, now electronic exchanges are pretty much taking over everything. But the New York Stock Exchange is still the most famous stock exchange in the world. It's one of the oldest, if it's not the oldest. In fact, why don't we find out if that's the case or not? If it's not, it's very old. Oh, it's not. The New York Stock Exchange goes back to 1792 when the Buttonwood Agreement was reached. Oh my, look at this. There's some older ones. That's the view. If you've ever been down in that area, whoever took this picture is standing on the stairs of Federal Hall, where George Washington was inaugurated as the first president of the United States. And it was done there because New York City was the first capital of the United States. Yes, it was. It lasted for about 18 months, and then it moved to Philadelphia for about 10 years before it finally moved on to Washington, D.C. On the left here, you can see this is actually J.P. Morgan's bank, which at the moment is standing empty. I'm not sure what the city's intentions are with that building, but you'd think they'd figure out something to do with it. And of course, over here on the right with the flag and the Greek columns and all the rest, that is in fact the New York Stock Exchange. Okay, so let's see. Now, the New York Stock Exchange, according to this, was established 1792. Although for many years prior to that, the Dutch were trading in that neighborhood. When the Dutch established New Amsterdam in the early 1600s, they were already exchanging stocks with each other, although not inside a building, but outside in this immediate vicinity. So according to this, the older ones are 1790, the Philadelphia Stock Exchange. Wow. I did not know this. The Paris Stock Exchange, 1724. And the euro, oh my God. Well, this makes sense to me because like I said, in New Amsterdam, already the Dutch were trading with each other. Probably they had experience with the Amsterdam Stock Exchange. So that when they came to the New World, it made sense that they would start trading in New Amsterdam. And well, here you go. Here's the proof of that. How do you like that? So the New York Stock Exchange is only number 4. All right. Now, I sneaked in here a picture that I took of it, not last Christmas, but the year before, when you were actually still allowed to go down to New York City. So this is my contribution. This is my picture of what it looks like at Christmas time. Of course, you're not allowed to go inside. The security is quite tight there. But we can look at it anyway. If you look at pictures, let's see what we can come up with. Well, there it is. This is the classic shot. That's of course, this must be before work starts in the morning or after work closes. You see there's nobody down there, but there's computers everywhere. And normally there'd be a bunch of people down there yelling at each other, trying to buy and sell stocks for their clients. So there they are. There's some guys trading. Yeah, they're still down there, although apparently they're, let's face it, electronic trading will eventually replace all of this. I don't know what they're planning on doing with the exchange when that happens, but I guess it'll hang in for a while longer, but not much. All right. So there's many stock exchanges throughout the world. NASDAQ, you all know very well because it's an electronics exchange. There's no people in there trading. And that was established, I believe, in the 1970s. And initially, they only had, high-tech companies listed on there, but now a lot of other companies are listed as well. We also have, of course, the London Stock Exchange and the Toronto, and you name it. Almost every major city in the world has a stock exchange. Even in the U.S., there are a lot of smaller regional exchanges, like there's one in San Francisco, for example. And as we've already seen, there's one in Philadelphia. So they're all over the place. Although probably that will change as, like I said, electronic trading takes over. Now, stocks that are too small to be listed on a proper exchange are traded in what's called the over-the-counter market. So what happens is this is traded directly between dealers, and they make their profit with what's called a bid-ask spread. What does that mean? Well, let's just say there's a market maker. This is somebody who is willing to buy and sell stocks, and they make a quote. They let it be known to the market that they're willing to buy Apple for 120 a share, but they're also willing to sell it to an investor for 122. So this is how they make their money, because they're buying it from you at only 120, and they're selling it to you for 122. Now, the $2 is compensation to them for doing this job. Okay, they're buying and selling stocks to whoever wants to do business with them. So they're making a $2 spread on every trade. And this is where their money comes from. So all dealer markets are set up this way. As where there's a bid price and there's an ask price. You as the individual buyer or seller are always at a disadvantage here. You always pay the higher price, you receive the lower price. The difference belongs to the dealer, but you're basically compensating them for the service that they're doing for you. Okay. Now, you may have noticed this in the foreign exchange markets if you've ever traveled to another country. When you buy currencies, the same thing happens. If you're buying a foreign currency, you'll be asked to pay a slightly higher price. And if you're selling one, you'll be asked to receive a slightly lower price. So in this case, for the dollar-pound exchange rate, we have a bid price of $1.20, an ask price of $1.24. And so that way, the dealer's making 4 cents on every trade, and that's their profit. Or that's 4 cents per pound, rather. Not on every trade, on every pound for each trade. And this is how they make their money. Now, I did mention electronic communication networks. These are designed to match up buyers and sellers of stocks. They're set up to supplement the trading activities of organized exchanges. And they also provide trading during off hours for other types of tradings, especially foreign exchange, where the markets essentially never close. Some of these are meant for large retail investors, and some are meant for individuals. I've personally not heard of any of these, but I've never tried to, do this, so I don't know. Okay. All right. Anyway, so maybe, all right, I guess maybe we got enough done here tonight. So I'll tell you what, let's stop here. And next week, I'll have some review questions for you to look at. And we'll do that in preparation for the midterm. And then in the meantime, we'll carry on with this chapter 10 with all the institutional details about stock trading. And then that'll lead to chapter 11, which is where we actually do pricing of stocks. And we also look at some pricing models as well, like the capital asset pricing model. So that discussion will require itself. It'll be a little bit more complicated. And then after that, we'll be focusing our attention on derivative securities, which are pretty involved, but we can pretty much do what we need to do in Excel. So we'll be getting a lot of Excel practice over the next few weeks. Okay, so in the meantime, I guess I'll just wish you all a good night, and I'll see you all next Tuesday. All right?
Thank you, Professor.
All right, you're welcome.
Bye, Professor. Have a good one.
All right, good night.
Good night.